Welcome to the sixth session of my course Financial Accounting 101. In this session, we will talk about the three financial statements, that is profit and loss account, the balance sheet, and the cash flow statement. Now, as we saw in our earlier videos that in practice there are many steps in accounting that will be followed in order to get the result, that is the three financial statements, profit and loss account, balance sheet, and the cash flow statement. The three most important questions that one needs to know from business are: first, what do I own and what do I owe? How much money have I made? And how much cash has came in, how much cash has gone out? The answer to the question, what do I own and what do I owe, is given by the balance sheet. The answer to the question, how much money I have made, is given by the statement of profit and loss. However, the answer to the question, how much cash has came in and how much cash has actually gone out of business, is given by the cash flow statement. So before we go ahead, let us understand the regulatory framework that governs accounting in India. In India, we have Companies Act 2013 that provides lots of rules and formats for presentation of all the three financial statements, especially Schedule 3 and Section 129 of the Companies Act 2013. Similarly, we also have the Partnership Act, if you are a partnership entity, that that provides certain rules for the accounting of partnership firms. The second one, or the second set of regulations that we have in India, is known as the Indian Accounting Standards, or known as the Ind AS, which is nothing but the Indian version of IFRS, that is the International Financial Reporting Standards. It has to be followed by all the listed companies and those unlisted companies whose net worth is equal to or greater than 250 crores. So Ind AS is followed by few listed, most all the listed companies, and few companies which are unlisted but have a net worth, there is a capital of more than 250 crores. The third set of rules that governs accounting in India are the accounting standards, or what we call as AS. All the companies that do not follow Ind AS have to follow the AS. So it's either of. Just a bit of caution over here. We have different set of rules for banks, NBFCs, and life insurance companies and general insurance companies. So this type of businesses have a totally different set of regulations to be followed. The fourth set of rules that is provided is under Section 145 of the Income Tax Act, which is known as the Income Computation and Disclosure Standards, or which is known as ICDS. In case the company is listed outside India, then it might have to follow US GAAP or IFRS, depending on where it is listed. Let us start with the first financial statement, known as the balance sheet. It is basically the cumulative report card of the company from day one of its start till today. You can see that there are two parts over here in the balance sheet. One is the liability side, another is the asset side. Liabilities are something that the company owes, or you can say that source of money, that is the areas from where the business gets money. Whereas assets are something that the company owns, that is, they are the areas or they are the assets in which the company has invested the funds. We simply call it application of funds. So liabilities are sources of funds and assets are application of funds. You can see over here on the liability side that there are two parts to it, that is equity, which is, so over here we have equity, A is equity and B are liabilities. In equity, we have two parts, equity share capital and other equity. So over here, part A1, equity, which is listed as liabilities due to entity concept of accounting, where the owner and the business are separated. Hence, equity, that is owner's money, is shown as liability, that is the business owes to the owners. It has to pay it back to the owners. There are two parts to equity. Part one is equity share capital, which is otherwise known as the contributed capital. That is the amount raised by selling of equity shares. And part two is other equity, or you call it the reserves and surplus, which is the amount of the past profits that is reinvested back in business. Part B has liabilities, which are broadly of two types, non-current and the current liabilities. The non-current liabilities are those liabilities that are to be paid after 1 year. They decide the solvency of business, whereas the current liabilities are those that are to be paid within 1 year and they decide upon the liquidity of business. On the other side of the balance sheet that we have seen over here is the asset side. Again, you can see there are two parts to it, A and B. We have non-current assets and current assets. Non-current assets are those assets that are used for more than 1 year, and current assets are those assets which will be consumed within 1 year. Please remember that the total of both sides, that is assets and liabilities, have to be same. That is, the source of fund should be equal to the application of fund. The next statement that you see over here is the profit and loss account. It shows the results of only 1 year as compared to balance sheet, which shows the results that you have generated from day one of your operations till now. This statement, that is the profit and loss account, shows you the results of only 1 year. Here you can see that I have divided this into 3 parts. The first is the trading account for the period ended 31st March. The second is the profit and loss account, and the third is the profit and loss appropriation account. Trading account shows the gross profit, which is equal to sales over the direct expenses. These are the direct expenses, are those expenses which are directly related to the production of goods and services. GP, as as I told you earlier, also it is one of the economics of business. If the company has loss at this level, then surely there is something fundamentally wrong in the business. Then we have the profit and loss account. So this gross profit that you find will come over here in the P&L account. The result of the P&L account, that is the sales over all business expenses, is known as the net profit. Now, net profit shows the management of business, where the GP shows the economics of business, net profit shows the management of business. The third part that I have shown over here is known as the profit and loss appropriation account. The profit and loss appropriation account shows the allocation of net profit, that is, it can be used to make tax payment, it can be used to give dividends to the shareholders, etc. So this is something known as the income statement, how it looks like. However, in this case, I have tried to show the P&L account, that is this part. The same details are there. However, they are shown in a vertical format as compared to the old T-shaped accounting that we did. Okay. We'll do this in detail as we go ahead in the videos to come. The next statement is the cash flow statement, which is one of the most truthful financial statements that you can ever have in these 3 statements. It shows the actual movement of cash in and cash out of the company. It is bifurcated into 2 parts, basically, so 3 parts. One is cash flow from operations, then cash flow from investing, and cash flow from financing. All these cash flows are having 2 things, that is cash inflow and cash outflow. Head 1, that is cash flow from operations, shows how much cash has been generated by doing business operations. So it is very, very critical. It shows you kitna paisa banaya hai dhanda karke. Head 2, cash flow from investing, shows how much cash has been invested or generated by buying or selling of long-term assets and the income generated through these investments. Head 3 over here is the cash flow from financing. That's over here, cash flow from financing, this part. It shows how much cash has been generated by raising new long-term funds. These funds can either be equity and or debt, and money spent to service them. So this part that you can see over here, cash from financing, it shows us the new money that has came in, new long-term money that has came in, either debt or equity. It is critical to understand that all these financial statements are interconnected as shown in this slide, where we start with the accounting equation of liabilities plus equity shareholders capital. So here we have assets are equal to liabilities plus the shareholders equity. Now the shareholders equity is broken into 2 parts: contributed capital, that is the equity share capital, plus the retained earnings, or you call the other equity or reserves and surplus. How do you get retained earnings? It's retained earnings at the beginning of the year plus the net income for the period minus the dividend for the period. Now, what is the net income from the period? So it comes over here, revenues for the period, sales minus the expenses. You can see that from down, we are starting over here as profit and loss account. And as we go up, we add it to the balance sheet. So this is very critical to understand that everything we do will be impacting all these 3 statements: profit and loss, balance sheet, and the cash flow statements in one manner or the other manner. Let us take an example over here. I have taken the example of depreciation. Depreciation is basically the reduction in the value of the asset due to its usage and passage of time. Here, depreciation is shown as an expense in the profit and loss account, while in the balance sheet, the value of assets gets reduced by the same amount, and in the cash flow statement, the same amount is added back to get the actual cash movement. As per depreciation, you are not going to pay anybody. is just a book entry which shows the reduction in the value of asset. Does a change in any one of these statements affect the other two? I will recommend to check the link in the description that I have given over here for a detailed explanation on depreciation. Thank you and have a great time ahead.